Something is breaking across the United States. Not in a way that makes headlines, not in a way that triggers panic, but in a way that quietly makes everyday life harder, more expensive, and less forgiving. For millions of Americans, the math no longer works. Paychecks arrive, bills get paid, and somehow there is less left over every month than there was before. Rent keeps rising. Insurance costs explode without warning. Groceries cost more even when you buy less. And despite what the official numbers say, this pressure is not easing. It's spreading. The reason this feels unsettling is because it's not happening everywhere at once. Some places still look fine. Some still show growth. Some still attract people. But beneath the surface, certain states are already buckling under cost of living pressure that wages cannot support. This is not a future problem. This is not a hypothetical recession scenario. This is the early stage of a system under strain. And when pressure builds inside an economy, it does not distribute evenly. It concentrates, it exposes weaknesses, and it breaks things where flexibility ran out first. If the United States enters a recession, these are the states that feel it first. Not because they are poorly run, but because their cost structures leave no room for error. When most people think about economic downturns, they think about layoffs. But job losses are rarely the first signal. The first cracks appear in costs, not employment. Housing becomes unaffordable. Insurance premiums spike. Taxes and fees rise quietly. Everyday expenses consume more of each paycheck. This pressure builds while people are still working. Savings shrink. Debt rises. Financial resilience disappears long before unemployment moves. Certain states are especially vulnerable to this kind of stress. States where housing costs surged faster than incomes. States where insurance markets are unstable. States where taxes and fixed expenses leave households with no margin. These places can look prosperous right up until they stop functioning. And once flexibility is gone, even a mild slowdown can cause outsized damage. That's why the states in this video matter. They are not predictions. They are pressure points. They show where the cost of living crisis stops being manageable and starts becoming destructive. We're going to start with the clearest example. California is not the worst state in America, but it is the first place where the cost of living equation failed completely. And once you understand what happened here, the rest of this list becomes impossible to ignore. California did not suddenly fall apart. It slowly became unaffordable, then inflexible, and finally, fragile. For years, housing costs in California rose far faster than wages for most workers. Not just in San Francisco or Los Angeles, but across entire regions of the state. Rents doubled in some areas. Home prices surged beyond what even above-average incomes could support. This wasn't a problem as long as income growth continued. But once that slowed, the system stopped working. Households earning six figures began spending extreme portions of their income just to stay housed. Savings disappeared. Debt replaced flexibility. And when there is no margin left, even small shocks become dangerous. Insurance exposed the next fault line. Major insurers began pulling back or exiting large parts of the state entirely. Homeowners were forced into fewer options, higher premiums, or bare minimum coverage. This wasn't optional spending. It was another fixed cost locked into an already stretched budget. Then came taxes and fees. California's tax structure relies heavily on income and capital gains. That works during booms. It becomes unstable when growth slows. As hiring cooled, especially in technology and related sectors, volatility spread outward. Layoffs reduced demand, bonuses disappeared, contract work dried up, but the bills did not fall. Rent stayed high, insurance stayed expensive, utilities rose, local fees crept higher. The result was not a collapse you could see on the news. It was a quiet erosion. People stopped moving forward. They delayed children. They delayed buying homes. They delayed everything that requires financial confidence. Some left the state entirely. Others stayed and adjusted downward. That is what early-stage economic stress looks like. California shows what happens when costs outrun income for too long. Not a dramatic failure, but a system that no longer supports normal life. And this is why California appears first on this list. Not because it is uniquely mismanaged, but because it ran out of slack before almost anywhere else. The pressure that built here is now visible in other states too, and once you know what to look for, it becomes impossible to ignore. Florida still looks strong. People are moving in. Construction continues. Tourism hasn't collapsed. On the surface, Florida appears resilient. That's exactly why it's dangerous. Florida's cost of living pressure is not obvious until you look at what households are actually paying to remain functional. Housing is the first fault line. Home prices and rents surged across the state in a very short period of time. Wages did not. Unlike coastal California, Florida's income base is heavily weighted towards service work, hospitality, healthcare, and logistics. These jobs do not scale upward quickly when costs rise. That mismatch matters. A household can absorb rising costs for a while, but when rent, utilities, and insurance rise together, there is no margin left. Insurance is where Florida becomes uniquely exposed. Home insurance premiums have surged across the state, in some cases doubling or tripling in a few years. Entire insurers have exited the market. This forces homeowners into limited options, state-backed insurance pools, or unaffordable coverage. Insurance is not discretionary. It is required to maintain housing and access credit. When insurance costs explode, they do not just hit homeowners, they raise rents, they strain landlords, they ripple through the entire housing system. Property taxes compound the problem. As home values rose, tax assessments followed. Even households that bought years ago saw fixed costs rise sharply without any increase in income. Florida's growth model assumed continuous inflow, more people, more demand, more spending. But growth-driven affordability breaks down quickly when momentum slows. If tourism weakens, if construction pauses, if credit tightens, the bills remain. That is the danger in Florida. It looks affordable until it suddenly isn't. It looks flexible until the fixed costs lock in. When pressure arrives, Florida households do not have the income buffers to absorb it quietly. They cut back fast. They fall behind quickly. The adjustment is sharp. Florida does not need a deep recession to feel stress. It only needs growth to slow. And that is why it appears early on this list. New York has always been expensive. But what's changed is who can still afford to stay. Housing costs in New York were already extreme before inflation accelerated. Rent and ownership costs decoupled from median incomes years ago. What kept the system functioning was concentration of high-paying jobs and constant inflow. That dynamic is weakening. Remote work broke the geographic lock that once forced workers to stay. High earners gained flexibility. Lower earners did not. As a result, the cost structure remained high while the income base became more fragile. Taxes amplify the strain. New York relies heavily on income and property taxes to fund public services. That works when population and income are stable or growing. When they are not, pressure builds quickly. Households do not experience this as a policy issue. They experience it as a shrinking paycheck. Utilities rise, transit costs climb, fees accumulate. Meanwhile, housing offers no relief. Rents remain high even as demand softens. Landlords do not lower prices easily because their own costs have risen. That creates a stalemate. Tenants are squeezed. Owners are leveraged. Neither side can absorb shock. Outside New York City, the picture does not improve. Upstate regions face weak wage growth, aging infrastructure, and declining tax bases. The state carries both extremes at once: high costs at the top, low resilience underneath. Employment numbers often hide this stress. Jobs may still exist, but income growth lags far behind living costs. People respond quietly. They leave the city. They delay moves. They downsize expectations. New York does not fail suddenly. It contracts. And when contraction begins, it exposes just how dependent the state has become on high earners sustaining a cost structure most people can no longer support. That is why New York consistently feels pressure early. Not because it is collapsing, but because it has very little room left to adjust. Texas is still widely marketed as the solution. Lower taxes, business-friendly policies, room to grow. That story no longer matches reality. Texas did not become fragile because it failed. It became fragile because it grew too fast, with the wrong assumptions baked in. For years, people moved to Texas believing housing would remain affordable. They bought homes believing costs would stay predictable. They planned their lives around stability. That stability is gone. Housing prices surged across Texas in a short window. Austin became one of the most inflated markets in the country. Dallas, Houston, and San Antonio followed. But Texas wages never matched the pace of rising housing costs. This is the first crack. Texas does not rely heavily on income tax. Instead, it relies on property taxes. As home values rose, tax bills rose with them. Homeowners didn't need to move, refinance, or upgrade to see their monthly costs jump. The bill arrived anyway. That locked people into higher fixed expenses they could not escape. Insurance made it worse. Texas homeowners face rising premiums tied to storm exposure, flooding, and infrastructure strain. Coverage narrowed, deductibles rose. Insurance is not optional. Without it, housing and credit collapse simultaneously. At the same time, wages flattened. Texas continued to add jobs, but many were lower-margin service roles. Income growth slowed just as costs accelerated. People were still employed. They were still earning, but their margin disappeared. Then interest rates rose. Refinancing vanished. Monthly payments increased. Households that stretched to buy lost flexibility overnight. This is where Texas becomes dangerous in a downturn. Growth masked fragility. The system assumed constant population inflow, cheap credit, rising home values. Remove any one of those, and the structure strains. When momentum slows, households do not have reserves. They do not have tax relief. They do not have falling costs to rely on. They absorb pressure quietly. Credit cards fill the gap. Savings disappear. Spending contracts. Defaults rise not as a wave, but as a steady leak. Texas does not collapse in headlines. It fractures at the household level, and when enough households break, the system follows. That is why Texas appears on this list. Not because it failed, but because its growth left no room for error. Arizona's growth looked effortless. People arrived. Construction expanded. Housing stretched outward into the desert. For a time, it worked. But Arizona's cost of living model was built on a fragile assumption that prices could rise faster than incomes indefinitely. They can't. Housing in Arizona surged well beyond what local wages could support. Investors moved in. Speculation followed. Prices detached from reality. Wages did not follow. Arizona's economy is heavily service-based. Hospitality, retail, healthcare support, logistics. These jobs do not scale upward quickly. As housing costs rose, households stretched. They accepted higher rent, longer commutes, larger shares of income devoted to housing. Margin disappeared quietly. Then inflation arrived. In Arizona, inflation hits harder. Extreme heat makes energy non-negotiable. Air conditioning is not optional. Utility costs spike during long summers. Transportation costs rise as sprawl increases. Commuting is unavoidable. Fuel becomes a fixed expense. Water costs matter more here. So does insurance. Insurance followed the same pattern seen elsewhere. Premiums rose. Coverage tightened. Protection weakened. At the same time, housing momentum stalled. Prices stopped rising. Demand cooled. Inventory increased. But costs did not fall. This creates a trap. Homeowners cannot sell without losses. Renters cannot save enough to move. New buyers cannot afford entry. Arizona households sit in the middle, stuck. Employment may still exist, but security does not. When growth slows, Arizona has no buffer. It relies on migration, construction, and credit availability. When those slow, the pressure concentrates immediately. Households begin cutting back. Debt replaces savings. Spending contracts. Small shocks become big problems. A medical bill, a job disruption, an unexpected repair. Arizona's growth masked fragility. It looked flexible. It was not. When prices stop rising, the illusion breaks. And once the illusion breaks, the adjustment is harsh. Arizona does not need a recession to feel pain. It only needs stagnation. And stagnation is enough to expose how thin the margin really is. Nevada is a pressure amplifier. When things are good, it looks fine. When conditions tighten, it breaks faster than almost anywhere else. That is not an accident. Nevada's economy is built on volatility, tourism, entertainment, hospitality, construction. These industries expand quickly in good times. They contract brutally when demand weakens. That alone would be manageable if household costs were low. They are not. Housing in Nevada surged aggressively, especially around Las Vegas and Reno. Rents rose far faster than wages. Home prices detached from what local incomes could support. People adjusted because they believed growth would continue. That belief is the first vulnerability. Nevada households rely heavily on variable income, tips, overtime, seasonal work, event-driven demand. When spending slows even slightly, income drops immediately. The bills do not. Rent remains fixed. Utilities remain fixed. Insurance remains fixed. There is no cushion. Insurance is an underappreciated stressor in Nevada. Extreme heat, water scarcity, fire exposure, infrastructure strain. Premiums rise, coverage narrows, deductibles increase. Nevada does not have a broad-based high-income employment base to offset this. There is no deep professional class smoothing downturns. When tourism slows, the impact is immediate and visible. Hours get cut before jobs disappear. Income shrinks before layoffs arrive. Households fall behind quietly. This is what makes Nevada dangerous in a slowdown. The adjustment happens fast, but silently. Credit fills the gap. Savings vanish. Defaults rise one household at a time. Nevada also lacks a strong safety net. Low taxes mean limited buffers during downturns. Public services strain quickly. Local governments have little room to respond. When pressure builds, it stays at the household level. There is no institutional shock absorber. People who arrive chasing affordability find themselves trapped by rising costs and falling income. They cannot save enough to leave. They cannot earn enough to stabilize. They wait. Nevada does not collapse loudly. It erodes quickly. And when erosion reaches a tipping point, it spreads through housing, credit, and consumption almost simultaneously. That is why Nevada consistently feels stress early. Not because it is mismanaged, but because it was never built for sustained pressure. Colorado looks stable, educated workforce, outdoor appeal, growing cities. But Colorado's cost of living stress is not visible unless you look past averages. Housing is the core problem. Prices surged across Denver, Boulder, and surrounding regions far faster than wages. What was once considered expensive but manageable became out of reach. This wasn't driven by local income growth. It was driven by migration, investment, and limited supply. The result is a state where professional class wages still struggle to keep up with housing costs. That matters, because when even higher earners feel squeezed, there is no buffer beneath them. Insurance adds another layer of pressure. Home insurance, car insurance, and health-related costs have all climbed steadily. Fire risk, weather volatility, infrastructure costs. These are not one-time increases. They compound. Utilities follow the same pattern. Energy costs rise in winter. Cooling costs rise in summer. Transportation costs rise as sprawl increases. Colorado households face year-round expense pressure. At the same time, income growth has slowed. Many of Colorado's jobs are tied to tech-adjacent work, professional services, construction, and tourism. When hiring cools, bonuses disappear and contract work dries up. Employment numbers remain stable. Income stability does not. This creates a psychological trap. People feel employed but insecure. They earn but cannot advance. They maintain lifestyle but lose flexibility. Debt replaces progress. Colorado's growth relied on affordability relative to coastal states. That advantage is gone. Once affordability disappears, migration slows. Once migration slows, demand softens. Once demand softens, housing stops rising. But costs do not fall. That is the danger. Households who bought near the top are locked in. Renters face high prices with little relief. New buyers are excluded entirely. This creates stagnation. Stagnation feels calm, but it is corrosive. People stop planning. They stop taking risks. They stop believing effort leads to stability. Colorado does not collapse dramatically. It tightens. And as it tightens, the pressure spreads downward, from professionals to service workers, from cities to suburbs, from optimism to quiet resignation. That is why Colorado belongs on this list. It is not failing. It is losing flexibility. And once flexibility is gone, pressure has nowhere left to go. Washington is often seen as insulated. High incomes, major employers, strong economic reputation. That perception is increasingly misleading. Washington's cost structure assumes a level of income stability that no longer exists for most households. Housing costs surged across Seattle, Tacoma, and surrounding regions far faster than wages for non-elite workers. Even professional incomes began to strain under rising rent, mortgages, and property taxes. This left households exposed. Insurance intensified the pressure. Home and auto insurance premiums rose alongside climate risk, infrastructure strain, and replacement costs. Coverage narrowed. Out-of-pocket risk increased. Utilities followed the same path. Energy costs rose. Fees accumulated quietly. Every bill became heavier. At the same time, the labor market shifted. Tech layoffs and hiring freezes didn't just affect engineers. They cascaded outward. Contractors lost work. Service jobs weakened. Local demand softened. Employment numbers stayed intact. Income security did not. Washington's tax structure compounds this. Sales taxes hit households hardest when disposable income shrinks. Every purchase becomes more expensive precisely when people can least absorb it. This creates a psychological break. People feel employed, but precarious. They earn, but cannot advance. They work, but fall behind. Washington's economy relies on a narrow band of high earners to sustain a broad cost structure. When that band weakens, pressure spreads rapidly downward. This is why Washington appears here. Not because it collapsed, but because its affordability depended on stability that no longer exists. And once that stability cracks, the cost of living pressure becomes relentless. Oregon's stress is quieter, less visible, less discussed, but deeply entrenched. Housing costs in Oregon rose steadily while wage growth lagged behind. Rent absorbed income. Ownership slipped out of reach. Households adjusted because they believed the trade-off was worth it. That belief is fading. Utilities rose. Fuel costs climbed. Transportation became unavoidable. Oregon's geography turns everyday life into a fixed-cost equation. Long commutes, limited alternatives, few ways to reduce spending without real sacrifice. Insurance followed the same pattern seen elsewhere. Higher premiums, narrower coverage, greater risk pushed onto households. Meanwhile, wage growth stagnated. Many of Oregon's jobs sit in education, healthcare support, logistics, and service sectors. These roles do not scale upward quickly when costs rise. That mismatch is now unavoidable. Households feel pressure from every direction at once. There is no single breaking point, just constant strain. People delay moves. They delay families. They delay everything. Oregon also lacks a strong rebound mechanism. It does not have rapid job churn. It does not have sudden income surges. When conditions tighten, they stay tight. This creates resignation. People stop expecting improvement. They simply try to endure. That is why Oregon belongs on this list. Not because it failed dramatically, but because it offers no release once pressure sets in. Illinois is the slow burn, not explosive, not sudden, but deeply structural. Housing costs in Illinois are not the highest in the country. That makes the stress harder to see. The problem is what sits underneath. High property taxes lock in permanent expense. Pension obligations strain public finances. Fees and assessments rise quietly. Households feel this as constant erosion. Even when housing prices stabilize, ownership remains expensive. Monthly costs do not fall. Wages struggle to compensate. Outside a narrow set of high-income roles, income growth is weak. Many jobs are stable but stagnant. That combination is dangerous. People stay employed, but they lose purchasing power year after year. Population decline worsens the cycle. As people leave, the tax base narrows. As the tax base narrows, costs concentrate on those who remain. There is no relief valve. Infrastructure ages, services strain, costs shift downward. Illinois does not collapse suddenly. It contracts inward. Households adapt by lowering expectations. They stop investing. They stop planning. The pressure becomes permanent. This is why Illinois belongs at the end of this list. Not because it is dramatic, but because it shows what happens when cost of living pressure never resolves. It doesn't explode, it settles in, and once it does, it becomes very hard to escape. By now, a pattern should be impossible to ignore. These states are not failing for the same reason. They are not collapsing in the same way, but they are all reacting to the same pressure. Costs rose faster than incomes. Flexibility disappeared. And once margin was gone, stress became permanent. This is what economic strain actually looks like in real life. Not a crash, not a headline, but a slow tightening that forces people to adjust downward again and again. People still work, they still pay bills, they still function. But they stop moving forward. That is the danger. Because systems do not break when people panic. They break when people quietly lose the ability to adapt, and that is already happening. What makes this unsettling is that none of these states are outliers anymore. They are early indicators. The same dynamics are spreading to other regions, other cities, other households that still believe they are insulated. They aren't. Cost of living pressure does not stay contained. It moves, it concentrates, it exposes weaknesses wherever flexibility has already been used up. This is why watching the signals matters more than watching the headlines. By the time national data confirms what people feel, the adjustment is already well underway. If you're wondering whether this pressure stops here, it doesn't. If you're wondering who feels it next, that's already becoming clear. And if you're trying to understand why everyday life feels harder, even when the economy is supposed to be stable, that question is exactly what this channel exists to examine. In the next videos, we'll break down where this pressure moves next, which cities are already showing the same strain, and how employment, credit, and housing interact when affordability breaks down. Because once you see the pattern, you can't unsee it. And the sooner you understand how the system is behaving, the harder it becomes to believe everything is fine.